We're joined by Kenneth Ho, MD and Chief Asia Credit Strategist at Goldman Sachs, exclusively talking to us at NDTV Profit. Kenneth, welcome to the show and always a pleasure to speak to you. You know, what are your takeaways? Because it's been a while or a couple of weeks since this entire credit, ECB space that has been opened up.
So our view is that in order for India to maintain and reach its potential growth, there needs to be an increase in terms of the investment to GDP ratio. And a big driver of that, we think, will be the corporate sector. And so an important path going forward, we think, is funding corporate capex going forward for the Indian economy. And our view is that we think there's going to be a multi-channel approach. So that would incorporate, obviously, bank lending domestically, some of the non-bank financial companies as well, bond markets locally, and also one important component we think will also be in terms of reliance on external borrowing. And so this easing of the external commercial borrowing framework, we think, is part of that overall plan. And we wrote a report last week and looking at some of the potential impact that these changes could have. And we think that this could actually drive or some sort of increase in the borrowing for India high-yield companies in the US dollar or in the offshore bond market. So we kind of look at this holistically as part of the overall funding for corporate India going forward.
All right, and that is the roadmap, and that is what it looks like going forward as well. Kenneth, this is Shreyansi as well joining in the conversation. I also wanted to understand where you think there is room for improvement. Is there anything more that you think is needed to push up animal spirits when it comes to corporate capex then?
So clearly, there's been a number of factors that has taken part. Partly is the relaxation of banking capital, so that should help the banking sector. Is the relaxation of the external commercial borrowing, which we just discussed. Is also important in terms of utilizing, for example, some of the domestic insurance investments in terms of funding towards longer dated borrowing as well. So we think it's a combination of all of those. Now, obviously, the credit demand has been a little bit slow from the corporate sector, and that we think will come through should we start to get stability going forward in terms of of the Indian economy, perhaps a little bit more clarity on the tariff front as well. So we think, again, it is a multi-channel approach.
Multi-channel approach is what you're watching out for, but how confident, Kenneth, are you that the asset quality will hold up if the banks really push hard on capex?
Well, if you look at the asset quality, we've come a long way from the peak in the non-performing assets a few years ago. So we do think that currently we are in a very strong position. And in fact, if you look a little bit broader, some of the vulnerabilities that investors have associated with India, say from around a decade ago, in terms of the current account situation or the fiscal deficit situation or the FX reserves, and obviously, the banking sector as well. So if you look at some of those vulnerabilities that investors have associated with India, certainly on the fixed income side around a decade ago, many of those have really improved quite significantly. We've also seen inflation come down quite noticeably as well. So we think if you look at, again, a little bit broader, many of those vulnerabilities have really improved significantly over the past decade. So we think this gives a pretty solid platform for some of those credit growth going forward.
All right, and tell you what, I also wanted to understand what you think about who's best placed to benefit from this opportunity. Do you feel only large banks are better placed to make use of this opportunity then?
So we think this is a multi-channel approach. So banks, non-banks, domestic bonds, foreign bonds. We think those could all play a part. And if you look at how the credit to the corporate sector has transitioned over the last 10, 15 years, it used to be more bank dominated and became a more diversified set of lenders. And so we think that's really kind of the path going forward. Is not really going to be kind of lending on one particular area or back to kind of over reliance on the large banks. We think it really is a multi-channel approach.
So with this multi-channel approach, Kenneth, how much foreign capital could actually find its way to India then?
We haven't got a number on that, but certainly if you look at or certainly in terms of my conversations with investors globally, there are positive views in terms of deploying more capital into India. The appetite across, from my perspective, the investors I speak with on the credit side, the appetite for high yield investing or even investment grade investing are really very strong. I mean, we've written quite extensively that the technical support across Asia for fixed income investment is very, very strong. The demand for those assets are really there. And we've seen investors across Asia really diversifying much of their credit investments. So instead of just relying on, for example, Asia US dollar market, they're looking broader in terms of different currencies, different products, different geographies. So definitely we think the demand is there. And so if there is more supply, if there is more credit generated, more bond issuance, certainly we do think that there will be sufficient demand based on a lot of the conversations that we've been having.
Okay, so this is going to be interesting from here on. Thank you, Kenneth, so much for joining us on the show. Always a pleasure to speak to you.